This is the Jones Lang LaSalle MarkerPulse news desk in Shanghai. I'm Michael Klibaner, head of research for China. In the second quarter of 2012, we saw office demand soften across the country. This has been true for multinational companies who are impacted by an uncertain outlook for the global economy and the Eurozone crisis, and also for domestic corporates who have been impacted by a softer domestic economy. In markets with very low vacancy and limited supply, such as Beijing and Wuhan, we've seen rents continue to rise, although not quite as quickly as they have in the past year. In Shanghai, rents have been relatively flat because vacancy rates are at all-time lows, but demand is still softer than in the past. When we look at Tier 2 cities, particularly those with new central business districts that are seeing quite a lot of supply, landlord pricing power is diminished and we've seen rents relatively flat. In the strata title market in the Yangtze River Delta, we've seen sentiment for buying these office units relatively weak, but interestingly in central and western China, demand for strata title office space has held up quite well. The outlook for the economy is also essential to this story. While we may not have resolution to the Eurozone crisis anytime soon, we expect the economy to rebound in terms of its growth rate in the second half, and that should be good for demand for office space by domestic corporates. And this is particularly important in Tier 2 cities, where domestic companies make up the majority of the demand for Grade A office space. Viewing the outlook for the second half and what will drive that rebound in growth, we look at two key factors. One is the outlook for infrastructure investment. The June data indicated a strong rebound in infrastructure investment spending, as well as a rebound in lending. The other key to the stronger outlook for the second half, in our perspective, is the housing sector. And here the recovery's been underway for some time. In the second quarter, discounting continued to be widespread, and mortgage availability improved, and so did the pricing. The two interest rate cuts in the last month have been very helpful for that, and transaction volumes have really started picking up. This is good for developers, and this is good for sentiment. We're not worried about price, however, because there's a lot of supply in the market. In fact, in the second quarter, the amount of new units launched doubled compared to the first quarter. We think this will limit developer pricing power, and that means transaction volumes pick up. That's good for the economy, it's good for developers, but prices don't go up because of supply. And that's good for the outlook for policy because government is still worried about price action. Now, related to this is the outlook for the retail sector. Consumer confidence and retail sales have been soft recently, and we attribute that to uncertainty about the economy and uncertainty about the housing sector. Now, if both improve in the second half, we think the retail sector will go along, and we expect to see improved consumer confidence relatively soon. I'll leave it there. This has been the second quarter review for the Jones Lang LaSalle MarkerPulse, China. Thank you.